Welcome everybody to another episode here at J2 Studios. Today we're going to talk to a special guest, Kris Gjylameti of Mutual of Omaha Bank, about getting a bank loan for your condominium, typically repairs or capital improvements. And so Kris has agreed to come in and explain kind of just the process of getting a loan, some of the important things that you have to do, the steps, and maybe some of the myths or some of the pitfalls that are surrounding this. And anyway, I'm sure you're going to find it a good show. So, Kris, thanks for coming in today. Tell us a little bit about how long you've been in the biz and what you do at Mutual of Omaha Bank and how you help specifically board members with their money needs and maybe give the audience a little insight into who Kris is.
Yeah. Well, thank you, Jens, for having us here. It's always great to be a part of an educational information group like yours. I've been in community association banking for 10 years, and I can't believe time flies. I've heard that before. Right. I can actually finally agree that it does. Mm-hmm. I started in banking 12 years ago, and I realized that community associations were around and they needed financing and they needed banking services. And came across my mentor, who Alan Crandall, has been in the business for over 30 years, and he offered me an opportunity to be part of this group 10 years ago. And the work has been fascinating. It's taken me from Washington to Oregon to Alaska and Hawaii, where I've helped the community associations with banking as well as financing. And it's been a fantastic experience. I've learned so much through it.
You probably have some cool stories.
I do, a couple.
Well, we'll get to those. Tell us something a little bit about you. What makes Kris?
Well, I think if I was to distill it, it would just be overcoming fear, overcoming, challenges. Mm-hmm. And one of the biggest challenges I've overcome is my fear of heights. I've been afraid of heights since I was a little kid, and when I was a teenager.
Like how tall? Break that down.
Yeah.
Like step ladder tall?
Over 2 feet now. It was interesting. I would go to a high-rise building and go to the side of the window and look down, and my palms would sweat, and it was just uncomfortable. And as a teenager, I didn't want to be in an uncomfortable situation. I wanted to overcome that. Mm-hmm. So I did what every other rational individual would do, and jumped out of a perfectly good airplane to overcome my fear of heights.
Did that help? Did that help?
It did. It actually helped for the first 5 years.
Then after that,
we got to get back into another jump here pretty soon.
Wow.
So it's been fascinating. But I think, working with community associations, there's certainly opportunities to, overcome challenges. And I love being part of that group of team that helps come together with a solution for them.
Right.
And that's a little bit about who I am.
Yeah, cool. Well, let's get right into it. So we're the board, or we're the HOA watching this, and we're saying, let's see, maybe a couple of examples. We've got an old community, and now it's time for capital improvement, like a big new roof project, or maybe new swimming pools, or something. Or it's, in our world, it's construction problems, and they need a big strip and reclad, and all of a sudden it's like, well, this project's going to cost $3 million. So where are we going to get $3 million? And is that typically where you're kind of drawn in? And maybe, I guess, start with, hey, we don't even look at things under this amount of money, or maybe there isn't that, but what's the typical loan look like for you, and the process look like for you?
Typical loan could be anywhere in this market. It could be anywhere between 1 to 3 million. Sometimes it's more, sometimes it's less.
Okay.
The process is fascinating because there's a right way to do things and there's a wrong way to do things. And the right way to do things is for boards, they have to really understand exactly what they're going to be repairing. Right. What are they trying to accomplish? And the only way for them to know this information isn't just, hey, this is what we believe we need. Right. They need to have somebody like you that comes in, identifies their building envelope issues, and the possible solution. I think that's a really critical step that sometimes boards oversee, or just get ahead of themselves and start talking about money before they know what their problems are.
Okay, so when they come to you expect them to have a detailed report, and that's probably, it's like, hey, I think we want 5 million. I don't know, 6.
Yeah.
But you'd say, well, what's the problem? Where's the contractor bids that back
Sure.
that up? What's the specific pieces there? So there's a little bit of work that they need to do before they call you. Is that safe to say?
It's not only safe to say, it's the right thing to do.
Okay.
They do need to identify what their problems are, the building problems are. The way to do that is by hiring a construction specialist, a building envelope specialist, like your firm, to identify the problems, work with the contractors, identify the repair costs. And then when you have that information, then you start getting involved with us as a lender or other lenders to identify how you finance part of that.
Okay. So what's the next step? They know they've got a $3 million project. Do they get a $3 million loan, or do they have to have some skin in the game, or what? Is it 80% loan to value, or what do you do there?
That's a great question. Well, these loans are specialized commercial loans, and unlike mortgages, what we look to accomplish is as lenders is give them the ability to take out 100% of the financing, or approve them for 100% of the financing.
Okay.
So if the association has a $3 million project, ideally what we'd want to have done is be able to approve them now for $3 million. Now it doesn't mean just because they were approved for $3 million, they actually will borrow $3 million, because as you probably have seen in projects you've been involved in, is that a lot of homeowners will use their checkbook or other sources of funding to pay for the project. So inevitably you end up getting prepayment monies that come in. So your loan that the association ends up borrowing is actually sometimes 50 or 60% of that starting amount.
So let's break that down a little bit. So $3 million project.
Yeah.
But say there's 300 units. 50 of them say, I don't want to deal with interest rates.
Yep.
I don't deal with banks. I've got some money in the bank. I've saved up. I knew I needed a roof on the last house, so I'd save the money for the roof. I moved into a condo. I know the building's going to need some maintenance. I'm going to write a check. So are they a part of the loan, or is that prepayment thing you're talking about?
Well, when you live in a community, you're going to be a part of everything that involves in the community association.
Okay.
But here's the thing, is that homeowner that writes the check is no longer responsible for that portion of the interest payment, because he's already paid the principal.
Gotcha.
So the savings, the benefit for the homeowner is, instead of paying a bank 5 or 6% interest,
Right.
just write your check, and your savings are the interest expense.
Gotcha.
Or the interest savings.
So those are the prepayments. So then the association would take those 50, say, prepaids, and then they wouldn't need to borrow $3 million. They'd only need to borrow 2.8 or whatever that number is.
That's correct.
Kind of how that works? Okay.
Yeah, but the reason, why do we want to underwrite as a bank? Why do you want to underwrite it to 100% of the financing that they need?
Okay.
That's a question that sometimes is not asked.
Okay.
And the reason why lenders should do that, and we do that, is because just because today your homeowners believe that they're able to write a check, tomorrow they may not, because their personal financial circumstances may change.
Gotcha.
And so while there's boards as well as community managers that will go out and spend time and survey their homeowners, which is a great thing to do, sometimes the reality of yesterday is not what we see today.
Sure.
And so it's important that we, again, are
Have
able
that
to...
option.
We have that option. Yeah.
Right. So you can take advantage of the loan or not. Okay. So let's see, aside from loans, so the resident can pay out of their savings account.
Yep.
They could, maybe get a home equity line of credit or something?
Or refinance
Or
their unit.
refinance the unit. Or the association could just raise the dues in an amount to pay for that. And so a loan becomes one more option. So let's talk about the advantage of a loan, especially with like a 5 to 7 year kind of lifespan. Do you have any kind of numbers or averages on?
Yeah.
Is it 20% less a month to do a loan, or what's been your experience for the benefit of the resident?
Well, so the benefits of having the financing in place is that it's an opportunity for homeowners that don't have the ability to pay upfront to spread that payment over a 5, 10, or 15-year period.
Yeah, you go 15. Wow. Okay.
Yeah, in some cases more, but generally up to 15.
Wow.
So it's an opportunity for them, instead of having to write a lump sum payment to the association, it's an opportunity to break down that payment over a longer term. Now, it doesn't mean that they have to continue that. If they want to pay it off in year 2 or 3, they can. Another benefit is just because the community association can raise a special assessment, it doesn't mean that it's going to be able to fund that special assessment.
Good point.
Because not 100% of your homeowners are going to be able to be in a position where they can write a check, especially when you have a multi-million-dollar special assessment and that portion of the individual could be anywhere between 30 to, I've seen it as high as 175,000 per unit.
Per unit?
Per unit.
Wow. Okay.
Obviously,
So-
that's a big check to write
right.
for
So
most of us.
get a loan. Okay. So in the old days, probably before you started, the of the couple banks that would loan,
Yeah.
they used to do individual liens on
Yeah.
every single resident, and that's not the case. And
That
so
is-
how does that work? These
Well,
days?
that's a great question. And so what we're talking about when it comes to individual liens, we're talking about title liens in their property, in their individual property.
Right.
And that is a very challenging credit structure for the association and the individuals. And the
Right.
reason why is because now you've got more filings and you have higher costs.
Right.
It's really a nightmare. And who administers all of that? What we do now, and I think the industry is catching up a little bit, is that we put a UCC filing on the association, so it's basically pledging future cash flow as collateral. And the homeowners can buy and sell throughout the project or throughout the loan term. It does not require a title lien and have to a title release for their unit to be able to be sold.
Okay, so break it down for me. You're securing the cash flow of the association. So
That's correct.
what is that?
It's the homeowner payments that come in every day or every
Monthly
month.
assessments.
Every monthly assessments. Yeah.
Okay.
And sometimes they're quarterly, and
Okay.
other times they may be annual, but it's the homeowner assessment.
Okay.
Yeah.
And so you guys take that into your bank then and control it, or how does that work?
We don't take it into the bank.
Mhm.
What we do is we place a UCC filing, so it's a lien, it's
Okay.
a cash flow lien
Okay.
on their future assessments,
Okay.
and that is our collateral.
So it's just one.
That is
It's
just one.
One through the board to the association.
Correct.
And so then, like you said, the residents are able to buy and sell
Mhm.
and come and go, and
Yep.
and are they? And I've heard actually in the buy and sell transactions,
Mhm.
sometimes that outstanding loan is actually negotiated to be paid off to the new buyer, or so
Yeah.
that's an
Or taken over.
advantage, or taken over.
Yeah.
And they are transferable when they just
Yeah.
Can they do?
Yeah. Yeah, the homeowners can
pretty
certainly
easy.
transfer to the. It's really a transaction between the buyer and the seller. If an
Okay.
association has a loan in place,
Okay.
and you are a homeowner that's selling, it's really a transaction between you as a seller and the buyer,
Okay.
whether that's going to be taken over or if it's going to be paid off. Now, here's an interesting statistic: is that nationally, we have a national footprint, as you know, and nationally, what we've seen over the years is that these loans are paid off in 2/3 of the time.
Oh, really?
So let's just say it's a 15-year loan. They're generally paid off in 10 years in
Okay.
that case, or 7. And the reason why that happens is that a lot of times homeowners will sell. And
Gotcha.
when they sell, they'll pay off the outstanding principal to the association.
Gotcha. Okay. What happens when a resident goes into foreclosure, or goes bankrupt, or walks away from their unit? Is it kind of like the same thing as the portion of the garbage bill, or is it what happens to their piece of that loan assessment?
Well, that's a great legal question.
Okay. Oh, sure. And you're not here to give legal
and
advice.
I'm not here to give
Yep.
legal advice. But what I understand from the 10 years that I've been doing this, as well as from the numerous attorneys that I've talked with,
Mhm.
is that the association has the ability, the powers, to collect after assessments that it is owed.
Okay.
And they utilize those same powers, legal powers, to go after homeowners that are delinquent
Okay.
in their special assessment as well as their regular assessments.
Gotcha. Okay.
Yeah.
So there's still some skin in the game, and
Yeah.
the people hang around. Okay. Gotcha. So why do we hear so many? I guess so many myths. I'd call it. I'd call it industry advisors, and that could be lawyers,
Yeah.
other bankers.
Mhm.
My brother's a banker, and he
Yeah.
said, managers, and they just say you can't get a loan. Is that kind of been your? There's really only about 3 of you in the thing that do a really good job at this.
Well, yeah.
And so, how do you deal with that, or what are some of the myths you've heard, or how do you overcome that?
I think the the industry is definitely evolving. I think there's more awareness now than there was 5-10 years ago.
Right.
But one of the challenges is, bad advice.
Right.
And we've come across that in the marketplace. And I think for a board member or for a manager, I think what they should know is that you should get a second opinion. If you have somebody that's telling you there's no way this is going to happen, and they don't have a plan of how to get to a yes for that association, you should ask somebody else and just say, look, what can we do with your institution? And one of the things that it's important to understand is that not every bank is the same.
Okay.
Their requirements in lending are different. Their appetite for loans is different.
Okay.
And so sometimes you'll have lenders that maybe don't want to do a loan that's under 50 units. Others, like my bank, our number of units that we're looking for is 25 or more.
Oh, okay.
So you should ask the questions of what are the minimum underwriting criteria of you as a bank, and can we fit into your program? And if not, you should certainly have a conversation with other lenders and see what you can do to get approved.
Okay. That's interesting. Give us a few more minimum underwriting requirements. So you're 25 units or more.
Yep, 25 units or more.
Is there an amount of the loan? Or
not an amount, but delinquencies are the number one killer for these deals.
Okay.
And the reason why that happens is that, as I mentioned before, these are cash flow backed. So the larger the delinquency portion, the larger the gap in cash flow.
Okay.
And it's pretty simple to understand. If you have a cash flow gap, meaning you don't have a lot of money coming into the association for operational as well as for reserve contributions, then you're probably going to have a tougher time being able to make the loan payments.
Okay.
So that's why these are the number one, killers for these deals is the delinquencies. Now, if you have, below industry average delinquencies.
So let's break down delinquency. So what is, you're not saying delinquency on your loan because you haven't given them one yet. So
what does that mean?
What is a delinquency?
Good question. A delinquency is a homeowner, for underwriting purposes, is a homeowner who's delinquent over 60 days.
Okay.
So they're delinquent on their assessments.
Okay. And then you're looking at a delinquency percentage or something?
Correct.
So 100 people, and we've got 11 people that are later than 60 days, so we would have 11% delinquency?
That's what that. That's right.
Okay.
That's exactly right.
And so then what are you looking for? What's your guidelines?
Our guidelines are 10% delinquent over 60 days. Ideally, we'd like to be between 7 to 10%. Sometimes we can go a little bit more, but again, we would have a mitigator to underwrite it around.
Okay.
So that's just a guideline. But
what's a little trick to clean up your delinquencies? And this is a loaded question. I know this. I know this answer.
Yeah.
So
well, maybe you like to say it.
well, what's the best way to clean that up?
Get the team, get your attorney involved. Get them to start collecting after assessments, past due assessments. Have a collections policy in place.
Okay.
Start going after those homeowners with your legal team. If you have any past due assessments, delinquent assessments that are no longer current owners, you got to ask the questions: who's part of your delinquency in your financials? Get them out of there because
current owners.
So you
have somebody that you're still
association
chasing. That's a good one.
Some associations are chasing delinquent owners that may have not lived there for 4 or 5 years.
Oh wow!
And they can still be reflected as a delinquent owner. Now, if you have a good underwriting team, they're going to ask those questions, but not always.
Right.
And so,
and the little example I was thinking of was we worked with the group, and they were right at 11%, and they needed to be 10. And it was just a simple, quick look through. They went and looked through it, and they realized, oh wait a second, here's a guy that has a $25 dog poop fine,
right,
and we're still arguing about it.
That's a good point.
Or a little $10 late fee that was never paid. He paid the rest of it, but that trickled into this. Yeah, he's 180 days out because he's still arguing about the dog poop.
Yeah.
Prove it's my dog. And so the group was like, wait a second, we're holding up a $3 million loan for a couple of guys.
Sure.
Like 25. One of the board members was like, I'm just going to pay the $35 and move on.
Yeah.
So just looking at it was a quick one.
You got to ask the questions.
Yeah.
What's in the financials? Now, the example you gave is a good point because there's fees that are part of the delinquencies that, for underwriting purposes, are not relevant. So a dog
okay.
poop $25 fee
Right.
isn't going to be a critical underwriting
Okay, for
criteria.
you guys.
So
Okay, gotcha.
for some banks.
Okay.
And so, what we're looking for is delinquency and assessments. If
Right.
there is a fee dispute, like a compliance fee or
Yeah.
something like that,
Yeah.
that may be different. That's
Okay.
a different story.
Just looking at it, cleaning it up, then
Right.
really kind of tackling moving a few little dials. Maybe we can get under that 10%,
Right.
or under, into that range.
Exactly.
Okay.
But again, there's a lot of, underwriting is a very complex process.
Right.
There's a lot of things that go into it.
Okay.
Delinquencies is one of them.
Okay.
Now, if you have a 30% delinquent association that's looking
Right.
for a multi-million-dollar process, you have a 30% gap in cash flow. That's going to be a challenge.
That's no problem.
That is a big problem.
Okay.
But another one is concentration of ownership.
What's that?
What that means is somebody in the community, whether it's an institutional investor or an individual, owns more than a certain percentage of the total units.
Right.
So that's a concentration of ownership. Now that could be as a result of an investor owning multiple units
Okay.
in the community. It could be somebody that owns a larger percentage of the community association commercial space, and that represents a significant part of the overall community.
Okay.
And the reason why that is a consideration for an underwriting team is, again, there's a concentration issue, and if they go bankrupt, now you have a cash flow problem.
Okay. Gotcha. That, I never thought of that. Yeah. Especially with a lot of the high-rise condos where they're commercial on the first floor, or even 9 floors of hotel, or so then you have different things to think about.
Sure.
Okay. So what are the quick and easy? I mean, I guess what are the? I know I need a loan. What are the 3 things I got to do? Delinquency. I got to.
Yeah.
Here's my delinquent report. We're looking good.
Sure.
How do I go about getting a loan or
So,
sending it to
couple of kind of key things you want to do is gotta look at your financials, make sure that you have a good standing, clean delinquent position.
Okay.
So ideally at or under 10% of the units delinquent over 60 days.
Okay.
You want to make sure that you have talked with your attorney.
Okay.
And have the ability to borrow and collateralize.
Ooh,
I can't
that could
tell
be a big
you.
one. Yeah.
Yeah, there's been associations that have approached us, and on the financial side of it, they're ready to go. However, legally, they still don't have that ability. Now they've got to stop.
And that would be in their
Governing documents.
Governing documents. Can they borrow money or not?
Correct.
And so, okay, gotcha.
And
So
if
talk to their attorney.
talk to their attorney. Just a quick conversation. We'll be able to tell you whether you need to start with your legal team or you need to start with your banking team.
Gotcha.
So let's say that you have the ability to borrow and you can move forward and collateralize. Those are 2 different abilities. But let's say you have the ability. What's the next thing? Just have a conversation with your management company.
Mm-hmm.
Are our financials ready? Do we have CPA reviewed or prepared financials? Are they internally prepared by the management agent?
Okay.
Again, depending on the lender, sometimes they're going to have requirements where we need more than just company prepared financials. Maybe we need to have a CPA prepared or even audited financials sometimes.
Okay, so they don't have to be audited, but that's kind of the top level of.
Correct.
Okay, gotcha. Okay, so ability to borrow.
Yep.
Not.
Yeah.
Have the money to do it. Clean financials.
Yep.
With CPA blessing. We started out with scope of repair and a contractor's bid ready to go.
Yep.
Anything else?
Ask the questions of what are the minimum unit of for underwriting purposes. How many, if you have 13 units, are you going to be able to help my association get $1 million loan? That may be tough for some banks.
Mm-hmm.
I know it would be a challenge for us. So ask the question of how many units, what is your minimum unit requirement? The other thing is basically having a reserve study. I know oftentimes
so current reserve study or
current
a
reserve study
in the future.
Current reserve study as
Okay.
well as an updated one.
Oh,
so,
okay.
I'll give you an example. We had an association that approached us for a multi-million-dollar loan on a great location in Kirkland, and multi-million-dollar loan. They didn't have a reserve study, and we said, well, look, we'd love to help you, but we need you guys to have a reserve study in place. First, there's state requirements, state law that requires you to have a reserve study. But second, we need to know how you're planning to proper reserve for your building envelope, even during and after the loan. And that's a critical aspect. So having a reserve study, having a management company that's helping you prepare financial documents that are professionally that we can actually read. We've had some challenges with self-managed communities where their idea of financial documents is short out of a napkin paper.
Okay.
And those are not going to be
right.
There's going to be challenging deals to work through.
But they could go to their CPA and have professional documents.
Yeah.
Yeah. Okay.
For deals for loans that are over a certain dollar amount, we also require third-party construction management.
Okay.
And for us, it's going to be $1 million plus.
Okay.
And I think the reason why that's a requirement for us is because we know the value that construction management brings to an association.
Right.
And so they need to have somebody like you in place to be able to help them through that process once the project starts.
Right. Yeah, no, that makes sense. So how does the loan, let's see, so we get the loan and then we start construction, and when does the loan start? I guess there's once construction's done, or what are we paying on during construction? It could be a 12-month project. So
sure.
What's going on during construction?
Well, I want to touch base on something else really quickly, and that's how do you pick the right loan?
Yeah, good. Yeah, talk.
I think it's critical. There's a couple of different, I think there's a few different options out there in the marketplace. And it's critical for associations as well as management companies to understand that there's a difference between the available products in the marketplace. So you have a line of credit to term as one product, and then you have a different product which is a draw period to term. So what is different about these two? Well, line of credit to term, the standard, in the industry that has been around since I started and before, is that the association takes out a line of credit, goes through the construction project, completes it, and then terms the loan for the 5, 10, or 15 years that it needs.
Okay. So that's a function. So my question was a function of the product you're using.
Right.
Okay.
So that's kind of the standard. But what's the pros and cons of that program? I think the pros is it gives you an opportunity to pay interest only on the draw period, on the line of credit period, and if you don't need to borrow all of it, you don't pay interest on it. So you're only paying on what you borrow, interest only. Now you finished your project, and instead of $3 million, you only needed to borrow 1 or 1.5 because a lot of the other money came in from prepayments, which, by the way, you've used. So it minimized your interest expense.
Okay.
Because you used your own capital first.
Right.
You didn't borrow any money. You didn't pay any interest. Now you term it out. Well, here's kind of the sticking point for me in this product, is that during that time, that may have passed 6 months, a year, or sometimes 2 years doing the construction project.
Right.
The interest rates in the marketplace may have changed.
Oh, good point.
And if they have changed, your bank may have the ability to renegotiate the interest rate based on the new market prices.
Gotcha.
Now, why is that a
variable rate loan stuff?
Well, it doesn't close until you term it. Is what it is. And so now, why is that important to you as a manager or as a board? Well, if the interest rates do change, you got to go back to the homeowners, and you got to tell them instead of $55 or $155 a month that you need to pay me, it needs to be a little bit higher, or a little bit lower. Now that's a good thing.
Right.
But we are in a raising rate environment right now.
Right.
So that's the first product. It's line of credit to term. Now draw period to term is functionally the same thing. You're drawing with invoices. You pay interest only on the money that you borrow. But the difference is that the interest rate is locked 6 days or 5 days or 4 days before closing. So even after 2 years of drawing, the bank is not going to renegotiate the interest if the market rates change.
Okay.
So those are two different products in the marketplace. And I think the associations and the board members need to know the difference between the two of them.
Right.
Because if we are going into a raising rate environment, like a lot of people believe, myself included, in 2 years or a year and a half, we may have a very different interest rate reality. And then going back to homeowners and asking them for more money is always going to be a tough challenge.
So in one case, the bank takes the risk of it going up and down.
That's right.
In the other case, the loan payer, the resident, takes the risk of it going up.
Correct.
And then given the time of project. So
Yep.
if it's an 18-month project versus a 3-month project,
Yeah.
you know, those are all
Sure.
business decisions that we need to make.
They are all
Okay.
business decisions, and the longer the project term,
Okay.
the higher the potential for the rates to change.
Right.
But also the structure. What kind of structure of the loan do you want as an association? Because there are different structures available in the marketplace. One of them is a variable interest
Mhm.
rate. What that means is that every so often,
Mhm.
the interest rate can change. So
Okay.
whether it's 5 years or 3 years or whatever you negotiate with
Mhm.
the lender, the interest rate will be readjusted based off an index as well as a spread.
Okay.
So the current kind of industry trend is every 5 years the interest rate could be adjusted.
Okay.
That's what's out there. But there's also fixed interest and term loans, which means that the interest rate is going to be fixed for the total duration of the interest rate, the loan term.
Okay.
And why that's an important difference to know is that while the fixed interest loans are going to be a little bit more expensive on the cost side, they're going to give you more peace of mind and budgeting as an association for your budgeting purposes.
Right. Let's see. A couple of questions floating around. One, okay, we're getting ready to borrow this money.
Yeah.
Do we need to do a vote, or is that probably in the governing documents?
You
Do
may
we need to vote on
be
it or
required
not?
to, based on your governing documents. Your
Okay.
attorney will be able to give you some. Your association attorney should be able to give you some clarification on it.
Gotcha.
If you have a vote that you have to go through, one of the things I recommend is have your banking professional come to your owners meeting
Right.
and talk about the loans and ask the question and answer the questions that are going to be asked.
Right.
Because if you as a board member try to take on that responsibility, you may not be able to answer the right questions.
Well, I watched a video
Yeah.
that J2 put out,
Right.
and they said
You should be an expert now.
well, I think this is the helpful piece of start that conversation,
Yeah.
but then definitely contact you and say, hey, come talk to us.
Sure.
And that's part of the service you offer.
Yes.
Okay. Perfect. The last question I had was we've got a reserve account. We know we're following the rules, and we have a reserve study, and we're saving some money, and we've got $500,000 in the bank, but then all of a sudden we got surprised and we need to spend $2 million.
Mm-hmm.
Do we only need to borrow 1.5, or do we need to keep this reserve going because there's other things that aren't getting fixed? And so how does that work? Do you just take all our reserve money? And then the other question is, since we've got $500,000, do we look more attractive to you from a lending standpoint?
Mm-hmm.
And so, I know I asked 17 questions
Yeah.
in there, but what happens with that reserve balance, I guess?
Well, first question is, what do we do with it? We have some money in the bank. Do we utilize it toward the project? Do we use it all? Do we use a part of it? Really depends on the association, depends on where they are in their financial, useful life of the components. Now, if you have $500,000 in the bank and you have $2 million worth of projects, I'm guessing you probably have other components that are going to be replaced or repaired in the near term.
Sure.
So one of the questions we're gonna have to answer is, could you use that money for other projects that are going to be needed? And if you deplete it, does that challenge your ability for your owners to get mortgage financing?
I guess that would come out in this reserve study that you're making us do.
That's right.
Right? Okay.
That's right.
So that's
the
one of
reserve study is
reasons.
going to give you clear direction of how you should be spending that reserve money. Now,
Gotcha.
there are circumstances where sometimes associations have put enough away where they will be able to dip into their reserves and use a portion of it. But very rarely do I see associations use all their reserve study or reserve funding to be able to put towards a project, because it depletes their reserves from other projects that they have coming up.
Okay. Gotcha.
So generally, we'll underwrite it at the total $2 million in this case, and if the association again wants to use a portion of it, they can.
Gotcha.
Does it make them more attractive as a risk factor, as a borrowing entity? It could. It
Okay.
certainly won't hurt,
Okay.
but it won't make it. It won't necessarily make it go over the approval line. There's other factors to look into: delinquency, concentration of ownership, and other things that while the reserve funds are great, it generally doesn't put them through
Gotcha.
the line.
So, just for a perspective piece, I'm just thinking through. If I'm going to borrow money,
Mm-hmm.
my credit card interest rate, that's between 14 and 25%. Okay. So my mortgage may be at 4, but my secondary mortgage is going to be at 7. I mean, it'll be a little bit higher. I'm thinking of my own personal, or not personal, but business line of credit. That's at 9.9. That's at 10%. What are these loans running in the in those things?
Today's market, I mean, depends on the bank. You know, today's market, I've seen them anywhere between, the low 4s, low to mid 4s to as high as 5.5.
Okay.
5.75.
Just barely above the mortgage, but still way below credit cards and then do I want to take all my cash and pay this thing off just so I don't have a loan? But wait a second, if I'm making 15% on the stock market and I can borrow for 5, I'm still making 10 over here. All of a sudden that loan starts becoming attractive. For a lot of reasons, but just an interest.
Well, one of the things is that the loan isn't going to be for all of the homeowners. It's not going to be the right solution, financial solution for all of the homeowners in any community.
Right.
But it's going to be practical solution for a percentage of them that they don't have those other options, or those other options are going to be more expensive choices for them.
Right.
And the other part of the reality is that at any point during the loan, at least with our bank, I'm not sure about others, but at any point during the portion of their loan, they can pay off their principal and not have to incur any interest expense anymore.
Right. Oh, that's great.
Yeah.
Can you think of any other, as we're kind of wrapping up, can you think of any other, things you wish, the top 3 things you wish the board would do, or what are some pieces of advice for somebody coming for a loan?
If it was just 3 things, the first one, again, we've talked about it in our conversation, but make sure you have the right team of professionals that's guiding you and helping you through this process. Oftentimes, they either don't have the team, they have only a portion of the team that's helping them, so maybe they have either a managing agent that's trying to help them through this process, but they don't have the construction management or construction expertise that's also part of it, or the legal. Get everybody involved. Get that group of folks that's going to be able to kind of help you as volunteer board members through that finish line. So that's the first piece of advice. Second piece of advice, have some conversations with lenders. Ask them what their underwriting requirements are. They should be able to give you some overview, and see if it's a lender that you connect with and you want to work with. Right. How much experience do they have? Have they been doing this for a month, or are they out there, this is their only business line? So those are the questions you want to ask, and the things you want to consider when you move forward in this process.
And then get your numbers, get your financials, get your delinquencies, get your reports. And I work with a lot of boards that don't have their finances, and for whatever reason, but it's just like, you need those. And that's, you made that perfectly clear, whether it's CPA or just, we need to see your numbers, we need to see if you're a loan, risk or not. So cool. All right, well, thank you so much, Kris, for being here.
Thank you for having us here.
And so we're going to have all of Kris's information on that last slide: phone numbers, emails, websites. So if you have any questions, I'm sure he'd be happy to talk to you and answer those questions for you. And as usual, if you're still with us, that means you found this content useful. And so we would really appreciate it if you share it. This helps us spread the message of the intent of these educational videos. And like us in all the usual places, and post your comments below. And Kris reminded me that he does have a couple of spreadsheets or PDFs. We'll put those down below, and you can download those as just kind of a few extra pieces for you. So thanks for watching.